If you're looking to raise capital for deals, you may want to understand the right deal structure and how to protect yourself and investors. And that's why you want to check out today's conversation with SEC attorney Nic McGrue. Now, Nic breaks down some of the ways you can lawfully raise capital for deals, but also goes through ways to protect yourself, having the right documents, but also knowing what and when to communicate with investors. If you are looking to make sure that you are raising capital the right way for your deals, or if you're a passive investor and want to make sure you're selecting the right investors to work with, make sure you check out this conversation right here on Multifamily Insights. You probably got interested in real estate for the cash flow, the tax advantages, the equity appreciation, and the long-term wealth creation, not for the 2 a.m. emergency maintenance calls. But let's face it, maintenance can be the biggest headache when it comes to building up your real estate portfolio. And that's why I want to tell you about a new property management software called Hemlane. See, Hemlane is more than your typical software. It's really like having a property management support system. First, Hemlane provides 24/7 repair coordination. They have a network of vetted maintenance technicians and professionals in your area to handle repair and maintenance your property may need. Second, Hemlane helps you advertise your listings and even connects you to licensed agents to help find and place tenants. And third, Hemlane is ranked #1 by Gartner with an average of 4.8 star reviews on repair coordination. Learn how Hemlane can help you manage your properties with 100% transparency and control without the administrative work. And as a Multifamily Insights listener, you will receive 25% off for 2 months when you sign up. Just go to hemlane.com, that's HEMLANE.com, and use Multifamily Podcast 25 as the promo code. Again, that's hemlane.com, or just click the link in the show notes. Nic McGrue is the founding attorney of Polymath Legal PC, specializing in transactional law across syndication, real estate, business, and entertainment. Now, he is licensed to practice law in California and Washington, and also holds a California real estate broker license. Beyond his legal practice, Nic is a tenured professor of business law, teaching business and real estate courses at multiple academic levels. Let's welcome to the show, Nic McGrue.
Hey, John, good to see you, man. Good to be back.
Likewise. We got a returning guest, Nic McGrue here. I'm excited to chat with you, man. For those folks who are not familiar with you and your story, why don't you take 2 minutes and fill in some of those gaps?
Yeah, so I'm Nic McGrue, the founder of Polymath Legal. At Polymath Legal, we help real estate investors lawfully raise capital so they can generate passive income while creating generational wealth. So if you're looking to raise capital and you're scared about all the securities regulations, we're the ones that are going to help you through that journey. And so I've had Polymath Legal since 2010. I've always been working in real estate in some form, and then moved heavily into the syndication space in about 2014, 2015. And so we've done a lot of things, seen a lot of things, and we're still going.
I love it, Nic. Well, you talked about a couple of things, right? So you've been in law for some time now. You've been in real estate law since 2010, focusing more on syndications, starting 2014, 2015. And you talked about helping people lawfully raise capital for their real estate deals. Let's start high level, right? So when it comes to raising capital for deals, for someone who is, interested in that, but don't know where to start, like, what are the ways we can do it? What are the legal ways to raise capital?
Yeah, so basically, if you're raising capital from passive investors, you're selling a security. So you've either got to go public, which is expensive and long and not what you're wanting to do in the real estate game, or you've got to find an exemption. And so that's where we come in. We figure out which exemptions might apply, and then which exemptions are ultimately going to fit best with you and your goals and your needs.
Okay, so there's an exemption. So when we talk about those exemptions, so first of all, you say go public. That means I'm like on the stock exchange kind of thing, kind of going public?
Okay. Yeah. So you're publicly traded. So lots and lots of disclosures, you have to have audited financials. The SEC is going to be looking at everything and anything that you've been involved with and doing. So very cumbersome process. And like I said, for my clients, it just doesn't make any sense in the real estate game. Now, if you're trying to advance to be a REIT, which is publicly traded, then that's the route you got to go. But outside of that, you've got lots and lots of other options.
Got it. So if you want to go big boy status with the REIT, great. Go the public route for 99.8% of our listeners. We're going to go one of the other routes with the exemptions. So what are those common exemptions?
So you've got some of the newer kids on the block, and it's weird. I've been doing this so long that they're not new anymore. They came from the Jobs Act in 2014, but you've got Regulation A and Reg CF. Now, those are options that you have, but in my practice for real estate syndicators, those ones often, again, don't make the most sense. They are a bit more expensive. They're a bit more extensive in the filing requirements, and with that, they also cost a lot more as well. And so the more common one that a lot of my real estate syndication clients use is Regulation D. And within that, there's subparts 506B and 506C. But the great thing about Regulation D is that you're allowed to raise an unlimited amount of capital from an unlimited number of investors. Now, we might put some requirements on those investors, but you can have an unlimited amount and you can essentially start raising as quickly as you and your team get all your documents together. So it's fairly fast. It's unlimited raise amounts, unlimited investors, and it's probably compared to Regulation A, Reg CF, and going public, it's also the more economical route as well.
Yeah, and this is what you typically see in syndications, right? Is most people are using kind of this Regulation D, 506C, or 506B offering because this is the mechanism that allows you to lawfully raise capital, but also is probably the simplest to understand and simplest to streamline and go through. So, real quick for those folks, you mentioned 506C, 506D, or B, excuse me, B as in boy, C as in Charlie. What are the differences there?
Yeah, so our big difference here is we're looking at who are your investors. And so with 506C, 100% of your investors must be accredited. So most people become accredited either by income or net worth. So if we're talking about individuals, it's an individual that makes $200,000 or more the past 2 years and expects to make that much or more this year. If we're talking about spouses, we up that number to 300,000. And if you're going to qualify based upon your net worth, then we take out the value and the equity in your primary residence. And if your net worth is $1 million or more, that's another way you can be accredited as well. So 506C says 100% of your investors must be accredited. So they got to be that high income, high net worth earners. But the benefit that you get is you can do general solicitation. So you can advertise, you can get people outside of your network to invest. As long as they're accredited, they can invest in your deal. And then we can contrast that with 506B. 506B says, okay, maybe you don't know a whole lot of accredited people. And that's what I get a lot of times that clients are saying, I want my network to invest and 100% of my network is not accredited. How can I let them in? So 506B is an option. And this says you can have up to 35 unaccredited investors. They must be sophisticated. So essentially they're financially savvy or they're working with a financial planner who is financially savvy. So up to 35 unaccredited but sophisticated investors. You can also have an unlimited number of accredited investors. But for all of those investors, whether they're accredited or not, you must have a pre-existing substantial relationship with them. So you had to know them before the deal is on the table. And essentially, you need to know whether they're accredited or sophisticated and the reasons why.
Yeah, really, really great information there. You mentioned 506B, 506C, C as in Charlie, being one where every investor has to be accredited, making $200,000, $300,000 if filing jointly, or have a net worth of $1 million, not including their primary residence. And then for 506B, they can be sophisticated, meaning they don't reach the accredited status. However, they do need to have some financial wherewithal, the ability to understand the investments, the knowledge there. But you can only have up to 35 non-accredited investors, and you have to have a pre-existing relationship with all of those investors, whether they're accredited or non-accredited. So lots of great information, and you certainly want somebody like Nic on your team to help you navigate that landscape. So Nic, for folks who maybe have done a deal or they're a little bit more familiar with syndications and kind of, the idea of raising capital, a few years ago, things felt, I don't want to say easy, but there was probably less rigor on the process, legal documentations and things like that. And it's funny because I remember you and I had a conversation some years ago, and we talked about like these documents, right? The PPM documents, the legal documents you're talking about, and it being one of those things where it's like, there's always stuff in there, and you never really want to have to come back and refer to it. But when you do, you want to make sure it's done right. Unfortunately, the market conditions have shifted, and I know a number of folks have had to go back to those documents and understand what's really in that agreement. First of all, high level, we've talked about the structure of the deal. Talk about like what is in a private placement memorandum, a PPM, and what kind of language do you advise your clients to make sure is in that agreement to protect themselves in the case of a deal having any issues?
Gotcha. Yeah. So from a high level, a PPM is basically, here I am, here's what I plan to do, and here are the things that could go wrong. So we're going to talk about the management team and their background, their experience, because that's who's kind of running the deal, and they have a large input as to the success of the investment or not. We also will talk about, what's the business plan? What are we buying? What is our plan with this? Why do we think this is a good idea? And then one of the big things that we'll talk about is risk factors. These are the things that could go wrong. And this is the SEC is very focused on disclosures. So they want these disclosures, and even more so, particularly in the case of syndications, because these are private offerings. So they're not public. Whereas if it's a public offering, there's additional lots of disclosures, and you're telling everything and anything. So all those potential investors know all of the ins and outs of the company. With this, the SEC says, okay, we're not going to make you do as extensive as disclosures as you are going public, but we do need to make sure that you let them know what are the skeletons in the closet. What are the things that you are up at night thinking about and hoping don't happen? Because we want to let the investor know about those things, and they can decide to move forward or to not move forward. But as long as you've disclosed it and they're moving forward from a place of knowledge, then it's okay. So those risk factors and disclosures are super important. And, one thing that clients always get mad at me about is that there's a couple places, I may have toned it down a little bit, but for a while, there are a couple places where in like bold, underlined, almost highlighted, where it says, you can lose all your money, like shouting from the rooftops, just because that is a risk. That's not what we want to happen, but that is a risk. And so for me, when I look at a PPM as a way to actually protect my clients, who typically are the issuers. I know the SEC looks at it as a way for investor protection, which I think it is. But I look at it from a viewpoint as, okay, what if these things that we've talked about do go wrong? What do we need to put in place? What do we need to disclose so that if these things happen, we can say, hey, we've done our duty to you. We told you that this was a potential outcome, and we're sorry that this was a potential outcome, but we let you know in advance, and you decide to invest nonetheless. So yeah, it's a big disclosure document. It's meant to allow the investors to make an informed decision, but I also think it's kind of meant to cover the issuers, because if you're doing it properly, then you will have fully disclosed everything. And so hopefully, if any of those things do go wrong, your documents will have addressed that, covered that, and talked about that already.
Nick, let's stay here because I think this is really, really important, right? You talked about the PPM document is really there to protect both parties, right? Your job is to protect the issuer since you're the one who is being hired by that issuer to draft these documents. But the SEC looks at it as a means to protect the investor, that LP investor, so that they understand the risk that could happen with the deal. You mentioned disclosures and making sure that those disclosures are clearly laid out in the deals, right? Or in the documents. I know a number of investors who are actually getting sued right now based on deals that aren't panning out. When we are looking at these documents, especially us investors who are not attorneys and don't know every legal language to put in the documents, what should we be looking for? What questions should we be asking our attorneys? Because I think that's the challenge for us is like, we don't know what should be in the document or should not be in the document. And we really are relying on kind of our legal expertise to ensure that the documents are written with the right language to protect and to disclose and inform all investors of potential risks. So tell us more of what we should be looking for whenever we're reviewing these documents.
Yeah, especially from an investor viewpoint, I'd say you really do want to see those risk factors. Because I do represent some investors who will say, hey, I got this PPM, I'm thinking of investing, but I don't know what any of this means. Take a look at it. And or they might say, it says that I might lose this, or it says that this thing might happen. And when I dive in there, if I see all this could go bad, this could go bad, that's going to go bad, that's going to go bad, I'm like, yes. I'm reading it and I'm like, okay, these seem like these might be some people that are good to invest in, because deals can go bad. We want them to go well, but the fact of the matter is that, and we're seeing a lot of that now, is that deals can go bad. So if I read a PPM on behalf of an investor and it's saying that everything's going to be roses, I say, hey, you need to talk to them because either they're hiding stuff or they just don't know what they need to disclose. But either way, that's going to be a problem for you as an investor. So oddly enough, I actually love it when I see if the PPM basically says the world's about to burn down, but invest in me anyway. I'm like, all right, they're doing they're doing their duty. Because yeah, I when I see those ones where everything is going to be good and it's going to be great, I say probably need to run because everything's not. We hope it's going to be good and great, but you shouldn't be having that as your baseline because that's typically not the case.
So I'm hearing you say from that LP investor, you want to see those disclosures. That's going to give you comfort that these people have actually thought through these challenges, or at a minimum, they're disclosing these potential risks. Hopefully, they've thought through how to mitigate those potential risks as well. And those are questions you should be asking then as an LP investor when you see that in the document. For the syndicator, what questions should we be asking our SEC attorneys or whoever's creating our documents to ensure that we are being protected and these documents are being drafted properly to provide the right level of protection?
Yeah, I'd say it's probably not so much questions, but your own disclosures. You want to, and one of the great things about, you can say all the jokes you want about lawyers, but one of the great things that come with having a lawyer is that you have attorney-client privilege. So I want you to tell me everything. Tell me all the bad stuff. Do not filter it at all. And I can let you know, is this something we need to disclose or something that's maybe not necessary? But I think the issues come into play, assuming you're working with a securities attorney that knows what they're doing. The issue comes when that attorney just is not aware of something. So they're not going to advise you to disclose something if they're not aware that this is a potential that you've thought of. And so one of the things that I ask my clients is I literally say, what are the things that are keeping you up at night? What are the things you're scared about? What are those things that are giving you anxiety? We may not, some of those might just be mindset stuff or other things that are not necessary to disclose. But I want to know that stuff so I can understand, is this something that I need to let other investors know? Or is this something that we just need to kind of work on with them? So yeah, I'd say there's not so much a lot of questions. I just say be completely 100% candid, and just tell them everything, and then they can filter it out. A lot of times I get clients that they're trying to kind of filter it out before they come to me. And so then I'm operating without a full deck of information, which is going to limit what I can do to protect them.
No, I appreciate that. You're talking about just really just telling your attorney what you need, what's going on, being a bit transparent there so you can have that conversation and dialogue. I know a lot of operators are, optimists, right? Real estate investors in general are very optimistic, right? We love to see all the things that can go right, and we don't spend as much time on the negative space. And I think it's almost natural for folks to shut down negative talk, right? We're such positive thinkers that when you start, getting into this space of everything that could go wrong, I mean, you could scare yourself out of the deal completely. So I can imagine there being a little bit of friction as you're trying to write out all the stuff that can go wrong. And the folks you're working with are like, hey, man, like, stop praying and putting these evil eyes on me and my deal. So for the folks who maybe have a harder time identifying the things that can go wrong, like in that process, is there kind of standard language or are there things that you look across the industry or just rely on from other experiences to ensure that that person is still protected?
Yeah, so there is some, we have my team, we have like a risk factor, just like a catalog, just a whole bunch of various risk factors that, because from all the ones we've done, that we can pull and just plug in. And so yeah, we'll do that on the initial thing. There's certain things that kind of every deal is going to have some basic similar ones, such as if you're doing value add, we don't know that renovations are going to increase the rental amount. We don't know that renovations are going to come in on time or on budget. And so those are things that if you're doing renovations, that's a risk that everybody's going to have. So we do have things like that. Then there also are things, just because we kind of stay on top of what the SEC is looking at and enforcing. And so like for the longest time, we had a COVID warning because obviously that changed how stuff works. Right now we have a bird flu one because that's something that's kind of moving through. Couple years ago, the SEC was looking at some companies saying you got to disclose how environmental impacts might affect your deal. So that's something we have in there. And then sometimes based upon location, if we have somebody buying in Florida, we're going to talk about hurricanes and tropical storms just because that's a place where there's a lot more extreme weather events. So some of it's, there are some kind of that we can kind of just figure out based upon what we know about the general business plan and the location and things like that. But I still will say, hey, let me know, what are you scared about? And when I have a client that says, oh, no, there's nothing, it's just a standard run of the mill deal, nothing at all, I say, go back and think about it. And then they come back and they have nothing. I say, go back and think about it some more. And if they do that a couple times, then I might say, all right, cool, we're good to go. But I just want to make sure that they're really thinking about what could go wrong, what's unique about this, what are some unique downfalls that could happen here, so that we can disclose them. And again, we hope they don't happen. But as you were talking about earlier, this is a document that we don't want to actually look at anymore. But if we have to look at it, we want to make sure that it has the stuff in there that we want it to have.
No, I appreciate that, right? It's important to have this process, and hopefully operators use it not just for a legal document, but also use it to help inform the business plan and mitigating said risk. With that said, I mentioned earlier that there's groups who are, either being sued or, things aren't panning out in the deal. So investors are taking the next level of action. What do you do in that situation? If you're an operator, you've got a PPM agreement, like, how does that work? What is the next step and what does that look like?
Yeah. So number one, you go back, start looking at the PPM and seeing. First thing I do, if a client says an investor's complaint or something like that, I figure out what's the complaint, and then I'm trying to make sure, have we accounted for this in the PPM? And usually we have. One of the things that I would say, even actually a step before this, and it's something that I've seen clients have success in their failure, so to speak. Communication, lots of communication and lots of advance. I've had clients that now they're having to do capital calls to save the asset. I've had clients that are, getting put under receivership or about to lose the asset and lose the capital. And some of the ones that are potentially going to lose the capital, they've disclosed that to the investors, and the investors are kind of just like, eh. And the reason is because for the last 9 months, they've been telling them things are looking bad. Here's what we're doing to try to fix it, but things are not looking good. And then the next month, here's what we tried out. This kind of mitigated something, but we have this other issue. Things are not looking good. We're working our butts off for you, but just want to let you know things are not looking good. So when we finally flash forward, 7, 8 months later, and things really, really aren't good, and it's kind of the writings on the wall, those investors are like, they're not happy about it, but they're not surprised. They're not shocked, because they're like, yeah, you've been telling me about this the last 9 months. So I kind of, again, this is not the goal, but I think a lot of them have kind of already just counted that money as gone, because they've been being told for the last 9 months that, yeah, that money is very much at risk right now. So I'd say that's the first thing you do well before you even have these issues. But then once you're having the issue, whatever it is, get on the phone, call your investors. Don't maybe send out an email after you've called everybody, but call your investors and talk to them, because that's another thing that I've seen some clients have success with. I had one client that they had to do a capital call, and there's a capital call just to preserve the capital, to hold on to what has already been invested. And they told me that one of their investors said, you know what, thank you so much for calling me. They said, you're my fourth deal that I'm having a capital call. Some of them just sent me a quick email and I couldn't get in touch with them. You took the time to actually talk with me to answer my questions. So I really appreciate that. And things like that go a long way. Um, it's not to say that this is absolutely going to stop things, but people typically don't like to sue somebody who they like, or somebody who they get along with, or somebody who they think is really looking out for them. And so that communication goes towards, one, fostering that relationship, but also showing them, hey, I'm not doing anything shady. I've been letting you know what's going on. I've been letting you know the course correction steps we've been trying to take. And now we are unfortunately in one of those sections in the PPM that said you could lose all your money. That's what we're dealing with. But there's no malfeasance going on. And so if you have that tight communication and that personal communication, that goes a long way from even if you are in a situation where you're losing the capital, it goes a long way to stop the investors from thinking, let me sue right away. But yeah, so that's what you do beforehand. Now, if you do have somebody kind of knocking on the doors, talking about lawsuits, one, I'd say make sure you hire counsel. I can give you the initial stuff, but I'm not a litigator. So I would not be the one that ultimately guides you through that. You'd want to hire counsel and talk with them to get an idea of what you should and should not say. But then I would still say be open to communicating with that investor. Sometimes people just want to be heard. They want to know that you understand that they're mad at you and that you did something wrong and that you need to feel that. And sometimes that might be enough. But yeah, I'd say after that, after if they are talking about litigation, get counsel, figure out the things that you shouldn't say, and then try to be as open with communication with them as you can.
Yeah, Nick, that's some amazing feedback, right? And first of all, you talked about you don't want it to get there. Like, obviously, you want the deal to work out in pencil, but before even any of that, it's clear communication. Whatever's going on with the deal, good or bad, communicate. And, the horror stories I hear typically are when people stop communicating, right? It's just like someone goes dark, you haven't heard from them in months. And what happens with people is like, as humans, when we don't, when we don't hear from you, whether it's real estate or anything, we just make up stories in our head and we fill in the gaps. And that story could be anything, right? And if I don't hear from you and I've invested money with you, it's my biggest fear. And in my mind, this person has, left and went to some island and is, what I mean? Like we've created and crafted these narratives. If I can't get a hold of you, I'm like, oh crap, what if this person just stole all my money? What if this happened? What if that happened? And that's why it's so important just to communicate, even if you don't have good news or real update.
Mhm.
Sometimes it's just, hey, not much has changed since the last time we spoke. We're still working on this. Here's the current status of that. I should know more in a couple weeks, right? Or I'll let you know
Yeah.
if anything changes. But sometimes you just need to respond, especially when you have the responsibility to raise the capital from other folks, because they are entrusting you with, with their earnings and with, kind of their savings here. And I think there is a responsibility for you as an operator. So part of it is just getting in front of it, having those conversations as much as you can before it gets to really the legal aspect of getting into lawsuits. But if you do find yourself in that situation, now you want to go get a litigator, get some representation, and then understand what's in the PPM, what kind of protections you have there, and you'll play things out from that standpoint. Are there are there things that you've seen either in a PPM or left out of a PPM that have created an issue getting into some of these litigation situations?
Yeah, I'd say, so here's one thing that I've been pushing clients to do post raise. It goes back to that communication. But if you're making, so how I draft my PPMs, the issuer has pretty wide latitude to make a lot of changes, to make a lot of decisions. But one thing that I've been doing probably the last year, maybe 18 months, is reaching out to clients and saying, hey, you raised 3 months ago, you raised 6 months ago, what's going on? What have you changed? What are you doing different? And depending on what it is, I might do a PPM supplement and just disclose that information to the investors. Sometimes maybe the asset is struggling, and so maybe you're bringing in pref equity or some other investment group that might sit above the investors, or they might be taking over the management. I disclose that sort of stuff because I've seen the SEC not come down super hard, but definitely were concerned about, well, you put this in the PPM, but then you end up doing this. Why didn't you tell them about that? So it's not so much something missing from the PPM because maybe wasn't part of the plan at the time. But if your plans change, you want to make sure you're letting the investors know about those changes and disclosing that. Trying to think of things that I've seen in a PPM that really hurts you. Um, I haven't seen it I've seen it in a PPM, and I told the investor not to invest, but it was basically saying that it didn't use the word guarantee, but it all but guaranteed
Oh
the
my
investment.
gosh.
And that's one where I said, they don't know what they're doing. And I would strongly caution you in giving them money because they need to have a better team around them because that should not be in the documents. I can't remember the exact language, but I was like, this is basically a guarantee and it shouldn't be even teetering on that kind of language.
Yeah, man, that's great advice because when you see something like that, it's always a red flag. Even when I'm talking to people, if they use that G word, I
Mhm.
stop them and listen. Nothing's guaranteed. I don't care what anyone tells you. Nothing is guaranteed in this space. So
Yeah.
there's a pref return that is not a guarantee. It's not the same. All it means is you'll get paid before I get paid. Hey Nick, so I think one of the questions that investors have is they're trying to figure out like building out their team. And obviously they can reach out to you and your team at Polymath Legal. Um, but how do we vet? Like, what do we need to be looking for in our SEC attorney in particular? Like, what should we look for? What questions should we ask? Like, how do we know we've got the right person on our team?
I'd say one big thing, and I can say this now since I've got it, experience. Just because if I look back at, thankfully, all these deals have exited now, and I wasn't necessarily doing anything wrong. But if I look at back at stuff that I did, back in 2014, I'm like, yeah, that had a little bit more risk on the client than necessary. So as you see a whole lot more stuff, you're able to account for it. I even have clients, when you look at the whole PPM documents, it's like 100 plus pages, and those risk factors we talked about, my boilerplate risk factor list just grows. The more issues I see, the more problems I see, the more things I'm like, oh, let's add this in. Let's make sure. And I'll say, team, let's make sure that we, as a standard, add these two clauses in because here's an issue we saw, and this is something everybody could potentially be subject to. So experience is one thing. So you want to vet what kind of experience, how long have they been doing it, what types of deals, that sort of stuff. I'd say another thing is just seeing how you relate with them. This is somebody that you're gonna, like I said before, you want to be able to be candid with them and trust them. So you want to make sure that it's somebody that you think you can build that rapport with. Um, Another thing that I look at is just how they charge, and this is not a be all end all, but we like flat rates because for me, one, I'm like, I've done this enough. I know generally the range of how much time it's going to take, what questions you're going to have, that sort of stuff. And so we like to do flat rates. One, on our end, we're not having to track you for every minute that we talk with you. And I want clients to be candid and talk with me if they need to. And then on your end, it's helpful because now you know exactly what that cost is going to be versus if you have a lot of questions or something funky is going on, then now your estimated legal costs are rising quite a bit. Another thing that I would look at is just how responsive are they to you when you're trying to get an initial meeting or in those pre-steps, because that can be an indicator of how responsive they might be to you once they have your retainer and they're working on your stuff.
Yeah, great tips there, right? You get it for one, their experience. Make sure you work with somebody who has plenty of experience, seen things in this space. The second is just rapport. Make sure there's somebody you feel comfortable talking to, you can share information with. Three is the fee structure, just understanding how they get paid. I think it's really important to understand that because you could wake up with a bill that's way higher than what you expect, especially if you're new. You're someone who asks a lot of questions or want a lot of changes or review stuff very in detail. That fee could add up very quickly, and they're not necessarily telling you every time that, hey, okay, that took me 3 hours, so that's X amount going to the bottom. Like, you don't really know some of that until it's like going to the hospital, right? You just go, the work's done, and then a few weeks later you get the bill, and you're like, wait, what? Man, if I'd known that, I would have drove myself to the hospital. Like, so make sure you know the fee structure.
Yeah.
And then the last is kind of the responsiveness and communication, right? Just understanding like how they communicate, are you working with that individual? Is it someone else on the team that you're going to be working with? How quickly do they get back to you? All those things are really, really important. So I appreciate you sharing that, Nick. Nick, we talk a lot about kind of the GP-LP structure and syndications. The other side of that equation is really just on the operator side, right? I'm sure you do a lot of JV partnerships, even on the syndication side, just operating partnerships where maybe some of those agreements, those partnerships have felt some friction, and maybe things aren't as great as they were when they initially started to invest together. From a JV or operating agreement standpoint, can you give us maybe a little bit more context of things we should be looking for, questions we should be asking as we're forming partnership agreements, primarily on the active side?
Yeah. So one big thing I'd say, especially if we're talking about partners, make sure that the people you're bringing on are people that you actually want to be partners. And that can take a couple of different meanings, but the main one that I'm meaning right now is that I see people sometimes say, oh, well, this person's good at underwriting, so I want them to be on my GP. And that could be great. There's nothing wrong with that. But I say, how do you work with this person? Do you like them? Are you wanting to grow something with them? Because if you're just looking at them as providing a specific service, you might want to just look at seeing if you can just compensate them, even if it's some sort of deferred compensation or payment with equity or something like that, just because it's kind of cliche, but when you're getting a partnership with somebody, it's a marriage. And you can almost think of an operating agreement as your prenup saying that, hey, this is what we're agreeing to. And if things go wrong, this is how we're going to resolve them. So I'd say first thing I'd say is, making sure, is this somebody that you actually need to have as your partner? And again, sometimes having a great underwriter is a need. So I'm not saying that that should not be a partner, but I'm saying that you shouldn't bring somebody on as a partner solely because they have a specific service that you're needing. I'm trying to think of some other tips that I'd say about that. Understanding what you're expecting from this partnership. And so a lot of times I'll tell clients, let's have both of y'all write out what you think your duties are and what you think the other person's duties are. And many, many times we'll see that those lists are not congruent. And so I say, let's work that out before we get into an agreement. And and that kind of stuff, or missing that kind of stuff, is what causes lots of issues. Because I still, maybe it's the altruist in me, but I still am a firm believer that in most cases, when there's partnership issues, people are not looking to do bad. A lot of times there's misunderstanding. Even if you have a written down agreement, there can be misunderstanding. So that's why I like to do that exercise where I say, you write down your duties and write down their duties, and we're going to have them do the same thing. And then y'all negotiate, because it's not going to be the same, but then we'll get a final one that actually has the duties that you're all agreeing to. And we can use that as kind of a metric to peg to see, is this partner meeting what they said they do, or are they falling short?
I love that. You gave two, but really you gave three, because you said something else that I think is its own third point. But three things you gave on a partnership, right? The first one is, do they actually need to be a partner? Are the skills and the talents that this person brings to the table worthy or necessary for partnership? Or is it just a task that you can pay out? Because, and I heard someone say this, and I love the way he said it. He said, if you bring on a partner, you expect that partner to be able to execute whatever it is you're asking them to do. Like, you shouldn't have to teach or train them how to do that. So if we're partnering together, you're supposed to be analyzing deals, and I'm supposed to be raising money and kind of, overseeing the deals. If I have to show you then how to analyze deals or help you with your analyzing deals, that's not a partnership then. I could hire somebody, I could hire an underwriter to do that. So just making sure you're clear on whether or not the person actually needs to be a partner. The second thing you talked about was the expectations of the partnership. So again, laying it out. What are your thoughts on your role, your partner's role, vice versa, and sit down and compare those lists. And it's a great way, because so many times people don't lay out the expectations. And you gave the example of like it being a marriage, but again, same thing. Like, people date and they think this is great, and then they get married and expect it to just be like they were dating, and it's not. And now there's issues because they didn't align on the expectations of what maybe a husband was supposed to do or what a wife was supposed to do, especially when you start bringing kids into the mix, right? Like, now it's all thrown off. So make sure you're clear on the expectations, because it's one thing to have a vision when you don't have that baby, right? That project. It's another thing when you have it and you like, oh, work needs to be done, and this doesn't necessarily fall into what I thought I was going to be doing. Well, who's going to take accountability for that? And then the last thing you said, which you said in the first one, but you mentioned that the operating agreement is kind of like the prenup. And I think just having a clear operating agreement where you lay out who does what, who's responsible for what, who gets what equity, what happens in a case of a dissolution, how are conflicts resolved. Like, that operating agreement is actually it's a real legit operating agreement. Yeah. And I think sometimes people rush through it as just a document to get a deal done and don't actually take the time to think through like the partnership and how are we going to resolve conflicts. If you and I are 50-50 partners and we disagree on something, how do we resolve that? Like, that's what the operating agreement is for. So just make sure you take the time to work through kind of those challenges. Nic, you gave a lot of great stuff so far. Anything we didn't talk about that you wish our listeners would know before they invest and partner with others?
Yeah, I'm just going to go back to, if you're an issuer, make sure you are communicating. And if you're an investor, the investment has risks. So make sure the person that you're investing in is disclosing those risks to you.
Yeah, you can check out more from Nic and his team. Go to polymathlegal.com. Right now, we're going to transition to our round of insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. All right, Nic, give me a failure or an apparent failure that set you up for later success.
I'm trying to think if I used this on when I talked with you last time. So I'd say it's probably almost one of my, I want to say a biggest failure, but definitely a setback. So I graduated law school in 2009, and the economy was actually worse than it is right now. So it was not
That's pretty bad, 2009.
Yeah. And so, when I graduated, normally when you graduate law school, whatever you do the summer before, you get a job offer and you have a job when you're graduating. And so I worked the summer before, worked at a company, and they said, yes, we'd love to hire you. Reach out to us in the wintertime and we'll solidify it. And, this was in August of 2008. So when January 2009 comes, they're like, yeah, we had to shut the office down that you were at. We had to lay people off. So sorry, we've got nothing. And so that was a big, big setback because my original plan was to work for 2 or 3 years and then start my own law firm. And so I ended up not having a job and was doing some tax consulting work and other kind of contract work here and there to pay the bills. But then during that time, I was just kind of reading every guidebook and talking to lots of senior lawyers, picking their brain to just kind of really learn more of the actual practice of law outside of the books. And many various other setbacks made it to where I started the firm probably sooner than I had planned to or thought I would. And it was definitely a struggle. The first probably 3 years was definitely a struggle. But super happy now, where I've landed now and how things are. I'm very, very glad that I did not have that job coming out. Whereas if you had asked me at the time, I was thinking this is so bad and going to be the end of the world. But that's a situation where, what I thought I wanted and thought I needed didn't work out, but it forced me to make other choices that put me in a place where I'm super happy today.
Love it, man. All right, give me a digital or mobile tech. And I'm going to say tech resource. I'm going to say it again. Give me a digital or mobile tech resource that you recommend for our listeners.
So I'm not one of the crazy ones because I've seen some people get super granular, but I love Notion. Notion, I use that with my assistant and I basically don't check my email. That has my long-term to-do list of everything. It also has what I've got to do today. I'm able to track habits and goals. And like I said, some people have their Notions super, super tricked out. I'm not there yet, but we have it pretty extensive. I even have a Notion for my house, how the housekeeper is supposed to clean certain rooms and where things go. So love it. It's just great organization. It can get very crazy, but if you manage that crazy and know what it is, I think it's superb for organization and knowing what you're planning to do, growing into, and all that good stuff.
Give me the book you recommended or gifted the most in the last year.
Book I recommended or gifted the most, probably Limitless by Jim Quick. I really like that. Now, I will say, so I read that probably 4 or 5 years ago. And I hadn't read a whole lot of self-help books before then. So I still like the book a whole lot. I will say that as I've read more, I'm oh, these books are all kind of the same. but Jim Quick's is a great one for sure.
Speaking of self-help, give me a daily habit that helps you stay focused on your goals.
Daily habit, I am either meditating or walking, which is for me a form of meditation as well. All right. So much chaos, and I have to do something that slows me down. Otherwise, my brain is going to just keep on going.
All right. Give me your number one insight for protecting yourself as a real estate investor legally.
I mean, I'm a biased one, but say get a great attorney.
So there you go. Get a great attorney. The rest will take care of itself. All right. Let's go in a different direction. Where are you located right now? LA?
Yep. I'm in Inglewood specifically.
Inglewood. All right. So you're located in Inglewood. Give us your favorite place to grab a bite to eat. And by the way, I am going to check to see what you said last time.
Okay.
To see if it's the same.
I think favorite place to grab a bite to eat now, It's got weird hours, but I'm not vegan, but I am vegetarian. This is a vegan restaurant, vegan soul food restaurant called Stuff I Eat, and it is delicious.
Stuff I
And
Eat.
even my carnivore friends enjoy it as well. So
All right, Stuff I Eat. So last time, let's see here, what'd you say? The last time, that's what you said, Stuff I Eat.
yeah. There
So
you
you
go.
really do, you're consistent. Awesome, man. Well, Stuff I Eat, you clearly like the place a lot, so we'll definitely make sure we put that back on the list and check it out the next time we are out that way. Nic, always great to talk to you, man. I appreciate you taking the time to break down a little bit about just the different ways you can lawfully invest in, passive investment opportunities in these deals, but also share more about what it takes to, raise capital, protect investors, disclose, what can go wrong, and then also some steps to take care of if you find yourself in a situation where a deal is not panning out, how to protect yourself, how to take care of investors, and make sure that you are communicating with them. Again, for folks, if you want to learn more, you can check out polymathlegal.com. Nic, thanks again for being a great guest. We look forward to staying in touch with you, and I hope you have a great day.